Hi, everybody. It's Mike Martin from Martin Chronicle and author of The Inner Voice of Trading. Today, I'm with a guy who's very, very distinguished in our space, and he's a guy who I attribute a lot of my success to, the very recognizable Jack Schwager. Jack, thanks for taking time today.
Yeah, happy to do it, Mike.
I wanted to get this out of the way very, very early because it's very meaningful for me. You know, outside of my own father, Jack, I can't think of a guy on the planet who's had a bigger impact on my life than you, primarily starting with one of the loves of my life, your very first Market Wizards book. I can trace any success that I've had as an author, a trader, a blogger, and a teacher back to those chapters in that first book, and I am deeply indebted to you. And so just from the bottom of my heart, I want to say thank you for having the idea and being your inimitable self and putting that book down on paper. I know I'm not the only person to tell you that, but I am really grateful for you. So thank you so much.
Oh, I appreciate that. Thanks.
How has written that book and all the interview books, as we call them, affected your life?
Well, I guess in a lot of ways. I guess it gave me notoriety or made me famous in a small circle. And I've always been in the financial world. And now if I go to meet managers and my role has been, I've had a role a lot of times as an allocator or whatever, and I have to meet managers. And just by virtue of having written those books, everybody always knows who I am. So it has a little bit of an advantage that way. It's kind of nice, also fulfilling a certain goal. When I wrote the first Market Wizards book, I thought it was a good idea. I just thought it was it'd be a fun idea to do.
You think?
And when I wrote that first book, my goal was that I had, at the time, and the book is still around, it's still a very famous book, Reminiscences of a Stock Operator. So that was kind of a book which, when I was writing Market Wizards, was about 60 years old. And I read that and I thought it was a great book. It was a really great book on trading. It's about, most of your listeners probably are familiar with it, but for those who aren't, it's a book that is about Jesse Livermore, written from the perspective of Jesse Livermore. The fellow who wrote it, Edwin Lefevre, was actually a real person. A lot of people for a while, I know back when I read it, some people thought that was a pseudonym. But
Right.
There really was Edwin Lefevre, and he was a journalist, and he wrote this book among others. And he wrote a number on the financial community. So the thing that impressed me was, here I am reading this book 60 years later, and it's still very, very pertinent, that there are lines in there that I could just pull out.
Right.
And I, in fact, have quoted those. I think I have myself quoted lines from that book. So when I was writing this, I wasn't going to do the book in a similar style, but my goal was, hey, I'm reading this book 60 years later. So my goal was, I wanted to do a book that 60 years later, traders would still be, reading. And so here we are, almost 25 years later, and people are still, I guess it's still kind of very widely read. So I guess in that way, having achieved the goal, that's satisfying. So that's one. I guess anytime you achieve something that's lasting, it feels good. It's had a positive impact. It's given me notoriety. It's been beneficial, to my own trading, just talking to these people. Even though trading has not been anything I've done hardly ever as a full-time avocation. And even when I did it, it was in a computerized way. But insofar as I've done trading from time to time, when I get time, it's more like a hobby than it's certainly it's not an avocation. If my trading would have to be classified as a hobby when I get inspired or have the time. And insofar as I've done that, I would have been a terrible trader had I not done these books. And by virtue of doing these books, I don't consider myself a good trader, but at least I'm a profitable trader. So
Right.
I'm sure monetarily, it's probably saved me money and made me no money.
Well, I keep all...
Sometime in my life I'll get more serious about it. But anyway, those are some of the ways.
Well, so I can see that spiritually it's affected you. Now, in terms of I wanted to ask you these questions up front because I know your book is a classic. It will be a classic. Even Ed Seykota wrote in the foreword of your new book, which we'll get to, that all of your books show up with what he likes or he deems as classics. I will share with you that what I like about, Market Wizards, your first one, which, this is the one that I carried around with me forever. I didn't care for Jesse Livermore as a guy. Like, he got under my skin real quick. Whereas the characters and the folks that you interviewed in your book, I liked them. Jesse Livermore, I wouldn't take 2 minutes of this guy's behavior before I'd want to punch him in the face. So I understand there's a lot of wisdom to be had, and virtually everybody actually in this book quotes Livermore. But just in terms of the character, he's a guy that grew on me very, very quickly, and I don't think I could really have a relationship with him, where I kind of fell in love with a lot of the guys here. Speaking of folks in the first book, it must have been very gratifying for you to see someone like Bruce Kovner, who you may have met, back in Commodities Corporation, to the launch of Caxton circa '83, and then through his retirement at the end of last year. You have what's probably, the best interview with Bruce Kovner. And certainly,
the only interview with Bruce
right.
Kovner.
I mean, this one, given how secretive he is, I'm sure he's still taking Xanax or whatever for all the panic attacks that he's had. Like, that in and of itself it must feel really good. And that was,
well, I knew Bruce, so I definitely had an advantage. But he told me quite up front in the beginning. He said, "You may wonder why I'm doing this interview," and he basically said, I said, "I'm getting too big now, and stories are being written about me, and I figured there may as well be, if there's going to be stuff written about me, there may as well be one accurate, story about me." And so he trusted me to do an honest portrayal. So that's why he agreed to do it. It was really only that. He figured he was going to get publicity one way or the other. None of it sanctioned, none of which he participated in.
right.
But he knew that if he participated with me, that it would be a fair representation, and that's why he agreed. As far as I know, maybe he's done another interview, I don't know, but as far as I know, that is the only interview I know of that he's done.
Yeah, I've seen things that were written about him that he's, maybe they picked up a quote where he's spoken, but anytime you've really seen him mentioned in the last 10 years, it's for his eleemosynary or charitable things that he's done for, like, Lincoln Center or for Juilliard or something, which...
And there's been other very, very sort of people who kind of completely shy of any publicity or notoriety or anything, and have just disappeared, like people like Monroe Trout or whatever. Again,
right.
I don't know if he ever gave another interview.
Right.
So there have been other people along the line that kind of I did these interviews with, and I don't know if they've ever done anything else.
One of the things that I think a reader can take away, and I'm saying this for like the two people who might not have known, or they're just getting into trading and they're going to start picking up your books, which would be a great investment on their time. Having read all your books, there seems to be some timeless wisdom that you can delineate or trace from one book to the next, where the message is somewhat the same, but because of the uniqueness or the idiosyncratic manner of the particular trader, it always comes out in his, or in Linda's case, hers, unique vernacular. In all of your books, you seem to be able to trace this wisdom from, one generation to the next. Your new book is right here, Hedge Fund Market Wizards, out on Wiley. What similarities did you see between traders, from, the first two Market Wizards books to this one, which has come out, more than a decade later? Did you notice anything similar between the traders?
Well, there are common denominators across all the books, because they're common denominators in terms of success. So those are similarities, but process-wise, traders tend to be very different now and then. But also, the traders in this book, which are all interviews done at the same time, are all very different from each other.
Right.
But the things so some things are very different. I mean, personalities are very different. Whether people are aggressive or they're more passive, or people are super brains, double PhDs, or they barely finished high school. You get a really range of traits in that respect, but there are certain aspects that relate to trading where there are commonalities, and that's true, of course, of almost any book. So something like discipline, which people hear about, get bored because they hear it so much, but it's true. Virtually every trader that I've ever spoken to has been successful, has been disciplined. Another one, which is very good, as an illustration of commonalities, is flexibility. So the reason ordinary traders and investors go wrong so often always boils down to a lack of flexibility. Positions going bad, they can't change their position, they can't change their mind, they can't take the loss. All these errors always relate to the lack of flexibility. And across all the books, you get this flexibility among really good traders. I could take the classic example of all time. I don't think anybody will ever beat this. Was Stan Druckenmiller in 1987, the Friday before the crash. Now, the Friday before the crash, Druckenmiller, he was managing multiple funds at the time, and he had been actually short. So he was, and people forget that the 87 crash didn't just materialize out of thin air. The market had been going down for a few months before the crash, and the week before the crash, the market went down a lot. I think some people don't, when they remember the crash, they forget that. And so here's Druckenmiller, and the market's going down a lot, and he thinks it's kind of now, all right, it's going down enough, and maybe for now. So what does he do on Friday before the Friday before the crash? He covers his entire short position. But if that's not bad enough, he goes long. Okay, so that's like the worst error you could ever make. I mean, I don't know. I can't make up a worse trading error than switching from short to long on Friday, October 16th, 1987. You can't make it up. You come in the next morning, the market's down 10% downside gap. But here's the thing. You go back and look at his record, and he's down a few percent for October 8th. Now, how is that possible, right?
Right.
Well, he made money for the first half of the month because he was on the right side. But here's the thing, and this is the amazing thing. Monday, he decided over the weekend he was wrong. Why people could read the book, it's tangential, okay? But he decided he was wrong. He had made a mistake. He came in Monday morning knowing he made a mistake. Unfortunately, the market didn't let him cover easily. It opened up about 10% lower on a gap. So what does he do? This new long position he put on, he got rid of all of it. But that's not all. He went back short again. So I kind of say that's like and that's flexibility, right? No loyalty to position, just doing what he knows is right. And I know we were chatting about this before, but in this book, I've got another trader where nothing as dramatic as that, but the same type of situation. I use a line describing what he did and other traders like him in the book, that good traders cover their positions when they're wrong, and great traders reverse their positions when they're wrong.
Exactly. That's at the end of the Jamie May chapter, which we're going to get to. Being flexible, it seems to me, and I wrote this at Amazon, that these traders are very emotionally demonstrative. They are very self-aware people, and they have strong inner voices where they're able to, they're not so up themselves in terms of their own postulates. In fact, there's one of them, and I have the note here, where, in fact, it is Jamie May, where he used the quote of trying to, or you did, of trying to drill 50 dry wells, and then he spends, the most amount of time trying to disprove his own ethos, where on Wall Street people get a theme and then they look for the ideas to support it. These guys find ideas and then they look to be their own worst enemy, their own judge and jury, and defend their thesis, and they try to poke holes in that.
Yeah, that's an excellent point. There really is. That's a fine point that you picked up. In Jamie May's case, they spend an enormous amount of time trying to disprove their own thesis. And in fact, that in particular trade we're talking about, the flexibility, that's exactly what happened. So he came up with this very plausible idea a couple of years ago that, China is growing, China's growing like crazy. They're starting to use a lot more coal. At one point, they were producing enough coal to export, and they finally reached a point where not only weren't they exporting coal, they were now starting to import coal, and the trend was going to go like this. So he thinks he has a bright idea. Coal, China's going to be buying all this coal. It's probably a good idea to be getting long dry bulk shippers, because there's going to be a lot more demand for space. And that was his idea. But the more research he did, he eventually figured out, or his group eventually figured out, that there had been, because of the commodity boom a couple of years earlier, there had been this massive expansion of shipbuilding, and there was actually a glut on the market.
Right.
So he realized that his original idea was not only wasn't a good idea, he was exactly the opposite of what she'd be doing. So he went short. Now, when he goes short, he doesn't go short literally. He bought puts, but that's another thing because his rights do trades. Leaving that aside for the moment, the idea is he took a short bias position, which was exactly opposite, and that was his single best trade of the year. So interestingly, the guy's best trade is the exact opposite of what his original idea was, and it was only because they spent months researching everything that he figured out he had it wrong.
You know, one of the traders that you mentioned in the book, Colin Moshe, who's in the macro section, the first third of the book, he talks about expressing some ideas, and he talks about being long, debit positions in the options market. And I found that interesting because I think back in the first book, Jim Rogers said something about 90% of the options expiring worthless. He didn't know why anyone would buy them, which I know is in a certain context. But almost every one of the guys here in this book, and they're all men in this one, talked about not just being flexible in their thoughts, but being flexible in how they participated in a trade, whether it was intra-commodity spread or whether it was a long-short equity position with a net exposure or not to the marketplace, or what have you. A lot of them expressed these ideas, these postulates, being long option premium. Can you reconcile that for us?
Yeah, I certainly can. So you actually touched on two important points. The one about the option premiums, which let's address that one first. But there's another one I want you to remind me about because it's very, very important. Has to do with the importance of how you implement a trade.
Right.
And so which we can talk about a story of Colin Moshe on that.
Right.
But let's talk about the options first. And this is really an important point. And I think anybody watching this, if you get this and you didn't realize it before, it's well worth you'll more than make up for the time of this watching this. This is like a massive misconception that people have. Now you hear this all the time. Like Rogers said, okay, that in some variation of options, buying options is a mug's game, right? Because if you buy options, they're usually overpriced, and you're gonna lose money. You have a negative edge. It's sort of like playing a casino. And on one level, it's true, which is why people get fooled by it. So let's talk about how it's true, and then let me explain why it's dead wrong. So why it's true is the same reason why insurance companies don't go broke. You buy home insurance, the public buys home insurance. So on balance, people who have home insurance will lose money by doing that. They will collect less premium.
Right.
Then they'll collect less in insurance. In collecting insurance on houses that burn down than they will pay out in premium. And if that weren't true, insurance companies would go broke. Same analogy applies to options. Options have to be priced, so the sellers of options will make some money over time, because otherwise, why should they take the risk of selling an option? And so it's logical that options should be priced at a level where, on average, sellers of options will make money. And you can do empirical studies, and I think it's like 75% of the time options, whatever, well, it actually depends how far that strikes are, so I guess it's a little odd to talk about percentages. But let's leave it this way. Let's say a good majority of the time, options expire worthless, and option sellers over time make money. So that's why this impression exists, because on that level, it's true. But here is the key thing that people overlook.
Right.
The beauty of options, and I'm talking about buying options, is that you don't have to buy an option all the time. You can choose when to buy the option. Now, if you're always buying options, then yeah, it's probably a losing proposition. However, if you wait for when you have reason to believe, fundamental or technical, that there's a potential big move in the market, and then you buy the option, then options not only provide you with this asymmetric return to risk, but they also have an edge. Because if you have some skill in picking your points, then the odds are in your favor. So I'll give you a personal example of a trade I did. I mean, I don't normally do this, but I hadn't been trading for many years, and I was just too busy doing a lot of other things. But in the 2008 crash, as the market was kind of coming down, I was looking at certain things like the FXI, which is the Chinese stock index, ETF,
Right.
and looking how far they were coming down, and I just thought, well, this looks like an extreme panic. Market's going to get overdone. I don't know where the bottom is, but let me buy far out, leaps and it goes down a few more points. Who cares? And if I'm right, it'll go up a lot. And that's the situation. So I would argue that after that crash had been going for a while, coming in and buying leaps in a market, in an index that's down like China, where there's some story why there should be a recovery, and the index is down 70%, if that's when you buy the option, I would argue you have an edge. Because the options are always priced on a probability that's an equal probability of going up or down. My attitude was when they were down that much in a panic market with a fundamental reason of why it should go higher,
Right.
that at that point, the odds of it going down another 50%, I thought, were much less than the odds of it going up 50%. Of course, it went up several 100%. I wasn't smart enough to stay with it for that, but that's an aside. The important point is putting on the option at that juncture. I don't think was an equal bet. I don't think the probability distribution reflected, what really was the situation. So if you can pick your points, then options don't have a negative edge; they can have an immense positive edge. And the other big plus is when you're a buyer of options, you can only lose a certain amount. Your risk is built in. Your potential is open-ended.
Right.
And the other related thing I would say here, and it comes up in the Jamie May interview as well, is that my personal bias is, and May's happened, and we were both, he was reflecting my own philosophy, is that you want to be a buyer of long-term options because you're paying a lot less premium per month, to have that position, particularly if you're looking for a big move.
Right.
So you combine those things, buying long-term options, picking your point, and so options can be one of the best trades around, the best ways to express an idea. So now, and I told you there was another point that I wanted to come back to, which is how you put on a trade. And so there, the thing I want to get to is most people think that it's all about getting the trade right, having the right trade. And one of the things I love about some of these interviews and some of the things that came out is when you get people saying things that are so either counterintuitive or things you never would have thought about or realized. And so one of Colin O'Shea's points was that how you put on the trade, how you execute your trade idea
Right.
is actually more important than the trade idea itself.
Yep.
And there's a great example that comes up there in the discussion of bubbles and so forth. So he had decided when the stock market, when the NASDAQ finally topped out in March of 2000, he had decided that was it. Okay, the bubble was over and all of that.
Right.
So naturally, the natural trade you might think is go short NASDAQ. Now, that's not what he did. And had you gone short NASDAQ at some point after that break, there's an excellent chance you would have been stopped out of the trade because, again, here's something people don't tend to realize or remember, is that the NASDAQ didn't just go down smoothly. We think, you might have a natural image of thinking the market peaked in 2000, the tech market, it just went down. And it did go down, but that initial 2000, in the summer 2000, you had a point where the market rebounded over 40%. That's quite a rebound, and not too many people I know that can survive a 40% rebound. So if you had gone short NASDAQ, you probably would have been stopped out and might have well lost money, even though the trade was totally right. What did O'Shea do? He didn't go short NASDAQ. He said, well, if this bubble is top, that means that the economy is going to get weaker, and that means that interest rates, which are now moderately high, are going to go down. And so what was the play? He bought bonds. And the bond move, interest rates was said to be much smoother. The interest rates came down smoothly, bonds went up smoothly. And so he used that concept to do a trade which was totally uh, totally correlated with this concept, but was a safe way to play it. And it's a good example of how you do the trade can be more important than the trade idea. Because somebody who just went short Nasdaq and had the right idea could have easily lost money.
Yeah, and that's something that even with, I have over 2 decades experience, I come back and look at. In fact, I was at the Milk and Global Conference and I had a chance to interview Boone Pickens. We're talking, of course, about the energy market. I talked to him about the spread between crude, West Texas Intermediate and Brent, and then also his take on natural gas. And, he said in terms of the natural gas, his play was he actually bought the strip out in 2015 to play the trade. Because I had asked him at the time, I think the OCD spread was trading 65 cents to December. Was that the trade where you could make money in what seemed like a directionless market? And so it just struck me like, here's a guy who's 80-something years old and he's trading calendar strips and natural gas to express an idea. It's really brilliant, and I think that's what the wisdom is that readers and viewers of this interview can take away, is that there's a lot of ways that you can express an idea in the marketplace, and when you get down to trying to get these asymmetric trade-offs, you have to find the one that's that has it, but it's also compatible with your personality. Right? I mean, Ed Seykota said that back in the first book, is that the goal is for a trader to develop a system with which he or she is compatible, and that is also echoed throughout this book. Say a little bit about that.
Yeah, I mean, I'll say this about that. When I give talks about what's important in trading, the first point I make, and when I tell people, if you get nothing else out of this whole talk, this is what you should know, is that to succeed in trading, you have to have an approach that matches your personality. And you see it time and time again. People evolve completely different approaches, but the successful traders always find a methodology that kind of works with who they are and what they believe in. And that's why you get completely diverse approaches. You get people who are like Rogers, who are pure fundamentalists and have complete disdain for technicians. His line about technicians is the only technicians that make money are the ones that sell their services. So you have that type of mentality about technical analysis. You have people who are like Seykota, who's purely technical, or Marty Schwartz, who talks about how he lost money continually in fundamentals and got rich as a technician. So you get these diametrical different approaches because they each evolve to what they believe in. So how is it possible for one guy to make money purely on fundamentals when he disdains technical, and have somebody else do the exact opposite? Is because Rogers really believes in the fundamentals and that works for him, and Schwartz, as an example, completely believes in the technicals and that works for him. So you have to find an approach that it's not that that's just simplistically fundamental and technical, but it goes down to how long the trades you are, what kind of trades. Something like J.D. May's always putting on, every trade I think he ever does is always asymmetric. He structures it so his potential is open-ended, his risk is limited. That's virtually, and that's the way, that's his mentality. That's what he's comfortable doing. He couldn't trade any other way.
The one thing that I teach about options is that, and there's several themes that are tied in here, which again is why I think your books are so rich, and treasure chest, basically, is that when you buy a debit, whether it's a vertical spread or whether it's a directional outright, trade in puts or calls, is that you kind of have a built-in stop. Like you were saying, it's what the loss is, but if you have trouble putting your arms around that ahead of time, you can think of it as having a built-in stop order, which takes a certain amount of discipline. Now, I was going to get this a little bit later, but one of the guys that you interviewed very late in the book, Joe Vidich, said that stop orders are for fools, and I know where he's coming again, because you have to take it in the context that he means it. I disagree generally with that, especially for newer traders. I also believe in time stops. Explain that for us. What's your take?
Okay, so Joe Vidich, let's put this in perspective. So yeah, he says that, and he believes that, and what he means that when most people use stops, they'll here's what he really means. He means that people tend to put stops in obvious places and they'll get taken out. And the floor is always taking advantage of, what used to be the floor and now professional traders is taking advantage of that. And that's what he's talking about. But here's a guy, what Hedge also, the other half of that story is that, and in fact, I titled that chapter, if I'm not mistaken, I think I called this chapter Harvesting Losses, I believe. So his right? Is that the title of the chapter? I don't have a book of it is. So his philosophy is you're always as a trader faced with this dilemma. If something's going against you, well, what do you do? And you on one hand you don't want to lose. You're afraid of losing too much. But on the other hand, you're afraid that if you cover, the market will turn around. So if he faces that type of situation, because he's not using stops. If you use stops, of course, you don't have to make that decision. But what he does, he'll take half, some portion. He'll take a quarter off, and then he does what Stevie Cohen does also. He'll take part, and then he'll take some more. And if it bounces back, then he can stay with it. But he's always kind of just taking his losses, taking money off the table. So he's a guy who has discipline and control. And he's also a guy who has, since he started managing money back in late 1999, I don't think he certainly hasn't had a drawdown greater than single digits. And I think his worst drawdown was like about 8% or something like that. And that's through these markets. That's through some pretty wild bear markets. So he has a lot of control over his losses, but he trusts himself to do it. And his approach is not to use stops, but to, as he calls it, harvesting losses. So one shouldn't take the wrong conclusion from that. That he's not that he's against stops. He's against putting in stops at obvious places, and he thinks you can do better. Well, he can do better. Again, if it's him, is to just take the losses gradually as he sees fit. The time stop issue that comes up in a lot of traders or a number of traders, and it's simply the concept, the idea that if I'm right and the market hasn't gone after some time, then I wasn't right. Something's wrong with the original concept. And yeah, I don't have to wait for it to get to my stop. I might as well just get out now and do something else. So that's something that a number of traders use, and that makes sense.
I will say that I use that probably more times than I care to admit. If you talk about putting on trades and being wrong more than half the time, in a simplistic view, there's only three things that can happen when you put on a trade. It either goes your way, it goes sideways, and you don't make or lose, or it goes down. But to me, in two of those threes, you still lose because you have the opportunity cost. And I'm always of the mindset that, I'm trying to, steal second base without taking my foot off first. So two of the three to me is you're a loser. What I like about, going back to the other point is the flexibility of scaling in and scaling out and being flexible of saying, sometimes really, if you're expecting very, very bullish news to come out and it does come out and it hits the tape, but yet the security that you're long doesn't move, that in and of itself is telling you something. And I know I'm probably echoing somebody from one of your earlier books, but all of that.
Or this book as well.
Yeah, there's a lot of people who are still reading the tape despite literally and figuratively, despite the advent of high-frequency trading, which didn't exist when you wrote the other books, or any of your books for that matter. What was your take on that, to hear people talk about reading the tape and watching the crowd reaction or the sentiment, right? You talked about the sentiment, bullish and bearish, but then also
that came up in a number of different places in this new Hedge Fund Market Wizard book. This idea that how markets respond is really important, and the emotionality involved. But one example, Michael Platt of Bluecrest talks about a trade again. This is not the one trader was going against it. He was looking for the yield curve to come in, I'm sorry, I got it backwards. He was looking for the yield curve to go out. Actually, it was like only about 30 basis points, 2 to 10, and he was looking for it to go out. And sort of all this news kept on coming out, which was negative for the trade. It looked like it should flatten the curve more, and the market nothing was happening. And just each time he thought, I'm going to get killed by this, and nothing happened.
Right.
So after a couple of those, he said, "Oh, this is telling me something." And he
right.
quadrupled his position.
Right.
And
It's a great story. It's a great
that's
story.
from 25 to 200. It was his biggest trade. It was Blue Crest's biggest trade that year.
So the story that Jack is telling us, folks, is about a trader who expressed an idea in a yield curve spread, not unlike the ones that Bruce Kovner said that he had fallen in love with early in his career. And this negative news came out that should have either flattened out the yield curve or kept it flat, and nothing happened. And he was watching all of this, thinking he was going to get killed. But at the end of the day, those fundamentals and the crowd reaction or lack of reaction to that news was a signal unto itself. And he basically, like Jack said, came in and quadrupled this position size. I think that's brilliant, you know.
I'll throw out one other thought here, which I think is potentially important, and that is about the use of fundamentals. Because on one level, fundamentals can be important if you're, you use fundamentals for ideas, basically long-term trades and that type of thing. But for timing purposes, and this is my quote, I'm not putting out traders, but my own feeling on that is that the only way that fundamentals are useful for timing is in a contrarian way. So if the markets don't respond to fundamentals the way you think they should, that's telling you something. In other words, so what it's telling you is the opposite of what, if it's a bullish fundamental and the market's not responding, that means it's bearish. So as far as a timing tool, fundamentals I think are only useful in contrarian fashion. Although in longer-term trades, it's a direct fashion. And one of the big mistakes people make is to use fundamentals for timing in a same direction. Oh, this is bullish news, I'll buy.
Right.
That's not, well, bullish news comes out, it may go up, it may go down. But what's really useful is when bullish news comes up and it goes down. That tells you something. If bullish news comes out and it goes up, it may continue to go up, it doesn't mean you should, but it doesn't tell you anything.
So what we're really saying there is that when news comes out, when it hits the tape or you find it on Twitter, what you're looking for, folks, is a divergence in the behavior of the security. What's the price telling you versus what is the news supposed to do? And if there's either a convergence or a divergence, that in and of itself tells you a lot of information about how everyone's positioned in the marketplace. Larry Benedict is a guy that you've interviewed for the new book, and he's a tape reader. Did you find that you found someone like him who relies so much on tape reading, given the advent of high-frequency trading and what that's done to the concept of tape reading, going back to like an Ace Greenberg style of tape reading?
Yeah, well, he admits it's made it more difficult for him. So he's had to, he's adapting. He's trying to, he's dealing with it. He's changing some things. So the advent of high-frequency traders has made it more difficult for him. But he's still doing fine. So maybe his return risk is going down. The last couple of years down, but he's absorbing it. And last year was his worst. Last year was his worst year. It was his only losing year in 20+ years. But he lost a fraction of one. Okay, so disclaimer here, this is my personal bias, okay? I personally don't find RSI a useful tool. And in fact, I will say this, and I know this was true when I looked at it 15, 20 years ago. I haven't looked at it again since then, but I'd take an even money bet that it's still true, that if you were going to buy every time the RSI got overbought and sell every time it got oversold, it's exactly the opposite of what the theory is, you'd make money. Or if you didn't make money, because you're going to pay transaction costs both ways, you get slippage both ways. But either you'd make money, which means you'd have to lose money doing the opposite, or you'd lose less money than you'd lose by selling when it gets overbought. So it's this confusion of, gee, every time the market tops or bottoms, the RSI is extreme territory. Oh, yeah, but you also have these immense segments of time where the RSI is overbought or oversold, and the market keeps on going. So I personally think it's a poor tool unless it's used. I'm not saying you can't figure out a way to use it. You could you can come out, maybe divergences and certain rules, maybe certainly possibly you can come up with some combination of 3 or 4 things, of one of which is the RSI. But maybe there is a way to use come up with patterns where the RSI is an input and might be of some use. But the typical textbook way that you see these things, which is using RSI to tell you when you should be, if it's too high, you want to be selling. If it's too low, you want to be buying. That, I would argue, is worse than random. It's kind of interesting because if you meet him, he was kind of like, hey, I come in, the guy's wearing, first of all, read the way he's dressed. He's wearing shorts and a t-shirt. It's Florida, but his office is like 65 degrees, and he's like joking around, easygoing, relaxed, just nice guy, sort of, you wouldn't know. I wouldn't have known he had that side at all. But yeah, he only went out of his way to point it out. And he had an assistant come in and asked him. They said, and the assistant tells me that they have an inventory of phones, computer terminals, because he's constantly smashing them against the wall. And he didn't have to tell me that. Now I know he's just being part of honest, and but he did. He was kind of celebrating, bragging about how back in the days, particularly when he was dealing with brokers on the floor, that when he got kind of taken advantage of on an order, that he would yell so loud that they knew when the floor below would hear him. So yeah, so I'm not sure, what his motivation was, but it was part of it was a side of his personality that I wouldn't have seen in an interview, but which he openly shared.
And basically tried to bull his way with a multi-billion-dollar position in a concentrated position. Could you imagine what would have happened with Man Financial or MF Global had that type of feedback mechanism been available inside the firm, up at the C-suite?
Well, obviously, the leadership styles were quite different.
Yeah.
It was also, that whole thing was a total violation of so many principles. It's almost, wouldn't know where to start.
It's almost as if,
It's the opposite of, we talked about flexibility before. It's the epitome of the absence of flexibility.
Yeah, I mean, Ed calls it the moron strategy. When you have a position on and it goes against you, you put more on, right? And
That sounds like it.
yeah, I liken it to being at Spring Lake in the Jersey Shore, and you're shoveling sand against the tide. If you have margin calls, the first thing you want to do is stop that bleeding and get out of the position. Then to kind of create more leverage by borrowing further money to put onto a losing position. David Bowie saying, putting out the fire with gasoline. I want to reiterate what I said at the beginning. Without Jack Schwager, there is no Michael Martin the way people would perceive him in the marketplace. And so, to me, you are my greatest teacher.